Happy Friday, Eric Bible at the Bible team at Neil Home Loans. Another week, and yes, another rise in mortgage interest rates. And yes, there was a ton of news this week and a ton of buzz around inflation. And is 2024 the new 2007? We'll dive into all that this week, but we'll start off with 30-year fixed mortgage as of this morning is sitting at 6.62%, up from last week's 6.26. And where, yes, that stings, it's moving closer to that 7% number. We did see some fall off yesterday, especially with some of the jobless claims. So we'll get into that this week and more. But I first want to start with inflation. As we've known through this cycle, inflation was the talking point. It's ultimately what created the Fed to hike interest rates at the federal funds level, which in turn drove yields higher, which in turn drove mortgage rates higher, so on and so forth. We got inflation yesterday, and it came in hotter than expected, but the market actually did not retaliate to that. And it was due to the fact that in tandem of that inflation report, both on headline and core, we got initial jobless claims. And there we saw a pretty significant rise in initial filings for unemployment. Now, keep in mind, this data was captured before Milton hit this week, but may take into account some of Helene, the previous hurricane. But for now, that was a signal to the market that really is the labor market on high alert? Is this a potential future piece that the Fed is focused on as well? And ultimately, bond traders, which control mortgage rates, caught wind of that. And yesterday was actually a fairly decent day in mortgage rates. So it could have been a worse Friday update. Another thing that I want to touch on is the Fed rate cuts and how that correlates to the 10-year and what the 10-year portends in regards to mortgage interest rates. So quick backstory. Typically, we follow the yield against the 10-year treasury to understand what mortgage rates are doing. Historically speaking, we've seen whatever the 10-year is, it's usually between 1.75 and 2% is kind of the normal spread. So if the 10-year is 2%, we can expect mortgage interest rates somewhere around 3.75 to 4. Historically, that has been the trend. As of recent, really encompassing the last 2 years, that spread has gone as high as 3%. Well, we've started to see that spread close. And more importantly, we look to history as our best reference point in relation to as the Fed starts cutting and what that does to the 10-year and ultimately what that can tell us into the future as far as mortgage rates. So this is some very exciting news. In my update, in my newsletter, I've included a beautifully prepared slide, courtesy of MBS Highway, our friends over there, Barry Abib, Dan Rosenberg, some wonderful, wonderful individuals that are very closely attuned to what the market is doing, what we can expect. And they shed some incredibly interesting light around what happens immediately post the initial Fed rate cut and what happens through the cycle. And we look at the 10-year treasury specifically. Historically speaking, immediately after that first cut, we see a spike. And like we've seen as of recent, since September 18th to today, the 10-year treasury has risen 36 basis points, which is why we're seeing mortgage interest rates on their attack as of late. But if we future cast into it and going back to the early 80s, historically speaking, post the first Fed rate cut and in relation to the 10-year treasury, on average, it falls by 37%. So with the 10-year peak at 4.16, we can expect the 10-year to drop potentially 1.35 to 2.35. And if historical spreads come back to where the 30-year fix in relation to the 10-year is that 1.75 mark, we can expect here in sometime in the near, not so distant future, mortgage interest rates landing around 4.75%. Now, I'm not gloating. There's a lot of things that have to take place for that to be a reality, but definitely something we're monitoring, we're watching, and something we're acutely aware of, and something that all of our buyers and sellers can be eager to watch for. And with that, that brings me to really our closing point around there's been a tremendous amount of buzz that 2024 is 2007. There's so many very, very alarming counterpoints, from the rise of the stock market to the first Fed rate cut taking place September 18th of 2007, and now September 18th of 2024. And we all know what happened post that first Fed rate cut. We saw the stock market tank, we saw the housing market tank, the financial crisis was upon us. And not to get so myopic around those details, the main differences now is centered around home equity. We go back to 2007, a majority of Americans are underwater. We look at home equity now, we have seen an explosion in home equity in relation to indebtedness tied to the home, but more importantly, inventory as well as demand. We look at '07, the lead into the financial crisis. Builders were building at a rapid pace. Builders have pulled back significantly. In resale homes, we are not seeing the pace or velocity of new homes hitting the market as we did in '07. No distressed home sellers, and builders aren't building at a feverish pace. So with that, we couple into an increasing population, more demand. It still appears, with very, very factual data, that home values will bode well. So this opportunity right now, where yes, interest rates have risen, they are below their peak. This now presents a massive opportunity again for our buyers to enter market with confidence, that lock in now and refinance when the crowd hits and when rates ultimately do fall. If you are struggling with conveying these points, if you need additional talking points, data to share with your client base, know we're here to support. As always, let's make it a fantastic Friday and an even greater weekend. Thank you.